If you ask the average person what caused the 2008 financial crisis, they will usually give you the same answer: greedy bankers, subprime mortgages, and a housing bubble that blew up the global economy. Everyone remembers the movie The Big Short. Everyone remembers the panic, and everyone assumes that because regulators put a bunch of new rules in place, a real estate collapse like that could never happen again. But human beings have a terrible habit of fighting the last war. While everyone is busy watching residential mortgages and obsessing over the Federal Reserve, a massive $2 trillion bomb has been quietly ticking in the background. And in 2026, the timer is finally hitting zero. This is the story of the commercial real estate crisis. It is a slow-moving train wreck that is going to wipe out hundreds of regional banks, destroy trillions in wealth, and potentially drag the entire economy down with it. And the craziest part? You walk past the epicenter of this crisis every single day. Welcome to the empty office building apocalypse. To understand how we got here, we have to look at the massive cultural shift that happened in 2020. Before the pandemic, corporate real estate was considered one of the safest investments on earth. Companies signed 10-year leases, paid their rent every month, and investors collected a steady, predictable yield. But then, remote work happened. Millions of people went home, set up laptops on their kitchen tables, and realized they didn't actually need to commute 2 hours a day to sit in a cubicle and send emails. At first, companies fought it. CEOs demanded that people return to the office, but the leverage had shifted. Employees resisted, hybrid work became the permanent standard, and companies quickly realized something else. Why are we paying $50,000 a month for a giant office in downtown Chicago if only 20% of our staff is actually showing up? So, when those long-term leases finally started expiring over the last couple of years, companies did the logical thing. They downsized. They didn't renew. Today, if you look at major cities like San Francisco, New York, or Chicago, the vacancy rates for office buildings are staggering. We are talking about 30, 40, and in some areas, almost 50% of office space sitting completely empty. They are ghost towns made of glass and steel. Now, if you are a normal person, you might be thinking, who cares? Oh no, a billionaire landlord loses some money. Cry me a river. But this is where you need to understand how the financial plumbing actually works. Because the billionaire landlord doesn't actually own that building outright. The bank does. And that is where the contagion starts. Commercial real estate is built entirely on a mountain of debt. But unlike your 30-year fixed-rate residential mortgage, commercial loans work differently. They are usually short-term loans, lasting 5 or 10 years, with a massive balloon payment at the end. When the loan matures, the landlord doesn't pay it off. They just refinance it into a new loan. It is a beautiful system, as long as two things are true. First, the building needs to be full of paying tenants. And second, interest rates need to stay low. Right now, in 2026, both of those pillars have completely collapsed. Over $1.5 trillion in commercial real estate loans are coming due right now. The landlords have to go to the bank to refinance. But when they get to the banker looks at the paperwork and says, "Wait a minute, your building is half empty, so your rental income has collapsed. And on top of that, interest rates are significantly higher today than they were when you took out this loan 5 years ago." The math no longer works. The landlord cannot afford the new monthly payments at the higher interest rate, and the building itself is now worth 50% less than it was before the pandemic. So, the landlord does the only thing that makes financial sense. They toss the keys on the banker's desk and walk away. They default. Suddenly, the bank is the proud new owner of a massive, empty, depreciating office building that nobody wants to buy. And this brings us to the most terrifying part of this entire scenario. Who exactly is holding all of these toxic commercial loans? If you think it is JP Morgan Chase, Bank of America, or Wells Fargo, you are wrong. The massive _quote_0__ banks saw this coming years ago and dumped their commercial real estate exposure. The bag holders are the regional banks, the small and medium-sized banks in your local community. Nearly 70% of all commercial real estate loans are sitting on the balance sheets of these regional banks. These are the exact same banks that hold the deposits for your local coffee shop, the plumbing company down the street, and the family-owned grocery store. They are the absolute lifeblood of small business lending in America. When a regional bank takes a massive loss on a defaulted office building, it burns a hole straight through their capital reserves. To survive, they have to stop lending. They freeze credit. They stop giving out loans to small businesses. They stop giving out auto loans. They pull back entirely just to stay solvent. And what happens to the economy when small businesses, which employ nearly half of the American workforce, can no longer get access to capital? They stop hiring. They start firing. And the dominoes begin to fall. This is the doom loop. Empty offices lead to landlord defaults. Landlord defaults lead to massive bank losses. Bank losses lead to a credit freeze. And a credit freeze leads to a recession. You might be asking, if this is such a massive problem, why haven't we seen hundreds of banks collapse already? Because the banking sector has been playing a game called extend and pretend. Instead of forcing the landlords into foreclosure and taking the loss on their balance sheets, the banks are just granting temporary extensions on the loans. They are pretending the building is still worth what it was in 2019, closing their eyes and praying to the Federal Reserve to drop interest rates back to zero. But the Fed cannot drop rates back to zero without reigniting massive inflation. The banks are trapped. The extend and pretend game is running out of time. Regulators are quietly preparing for a wave of bank consolidations. In plain English, that means letting the weak regional banks fail and forcing the mega banks to swallow them up. We are watching the slow, deliberate execution of the regional banking system in the United States. The 2008 crisis was a sudden, violent explosion caused by residential housing. The 2026 crisis is a slow, agonizing bleed caused by commercial real estate. It doesn't happen overnight. It happens one empty office building and one regional bank at a time. So what should you do? First, make absolutely sure that your cash is spread out and fully protected by FDIC insurance limits. Do not keep uninsured deposits in a mid-sized regional bank heavily exposed to commercial real estate. Second, understand that the era of cheap credit is over. If you run a small business, secure your credit lines now before the banks tighten their lending standards even further. Wall Street wants you to look at the record highs in the stock market and ignore the rotting foundation underneath it. But the bill for the remote work revolution has finally come due. And the people paying for it won't be the billionaires who walked away from their leases. It will be the rest of us, dealing with the economic fallout of a frozen credit market. Keep your eyes open and don't let the headlines distract you from the actual data. Hit the subscribe button if you want to stay ahead of the narrative. See you in the next one.